Hey, are you thinking about using your VA loan but you're not sure how it works? Well, stay tuned. That's what this video is going to be talking about. Keep watching for tips and tricks you don't want to miss. And remember to like and subscribe if you've learned something today. I'm Christine Scala. I'm a realtor here in Augusta, Georgia. I'm prior military and I've used the VA loan a few times. So I know that it can get confusing, and I wanted to share with you some of the research that I've done so that you can know what you need to know to get started. First, let's talk about some of the benefits of the VA loan. The first benefit is that there's no down payment required. You can finance up to 100% of your VA county loan limit. PMI stands for Private Mortgage Insurance, and it's arranged by the lender. In most cases, if you've got a conventional loan and you don't have the 20% to put down, they've arranged for the PMI in case you were to stop making your payments. But with a VA loan, there is no PMI. Another advantage of a VA loan is that your packet is reviewed by an actual person, not a computer. I do want to touch on one common misconception that a VA loan is always the best route to go. That's not true. Usually it is, but not always. There are VA funding fees in addition to lender fees, and you need to weigh out all of those options to make sure that this is the best approach for you. Next topic I want to touch on is what kinds of properties can you use a VA loan for? The first type of property we'll talk about is condos. Now, while you are able to use a VA loan on condos, it has to be a VA approved condo. There's an online database that's listed what condo associations are acceptable. Now, that's not the management company, that would be the condo association. You can also use a VA loan to do what's called house hacking. So you could use it for a duplex, a triplex, or a quadplex. So let's say that you wanted to buy a duplex. You would have to live in one half of the duplex, and then you're able to rent out the other half of the duplex. So let's say your mortgage is $1,000 and you can rent the one side for $850. You only have to cover the difference for your mortgage payment. Now, there are stipulations that come along with that. One, they usually require about 6 months of payments in reserve. Two, you have to have some type of landlord experience. Now, that could mean that you were a barracks NCO. Now, keep in mind that this type of home only works if you plan on living in one of the units. The next type of property you can use a VA home loan for is a new build, new construction. Now, while technically the VA does allow you to purchase land and build a home on it, it's really difficult to find a lender who will approve this process. Most times they have you get a construction loan, and then once the home is completed, then you can refinance and get a VA loan on the land and the home that's already built. The next topic that we'll talk about today is eligibility. So a veteran means someone who served in the active military. Only the VA can determine eligibility, but the following are general guidelines for informational purposes. You may need a statement of service from your command if you're on active duty, or a copy of your DD-214 if you're no longer active. The VA does not have a minimum credit score, but many lenders put restrictions on that. There's an eBenefits website, the link is down below, and you can go on there to check your eligibility. But most of the time, if you're going to a lender, it's much quicker for them to get your certificate of eligibility through the lender. So the requirements are: your first enlistment was completed under honorable conditions. You've served 90 days or more in active duty service during a time of war, or served 181 days in peacetime. You're more than 6 years in the National Guard or Reserves, or 90 days or more on Title 10 orders, and were honorably discharged or still serving. You must have the intent for the home to be your primary residence for 12 months. Now, they understand that things come up, and let's say you come down on orders, there's a minimum of 180 days that you have to live in the home. You must generally occupy within 60 days of closing. A spouse or a child can satisfy this requirement. Like, let's say that you're stationed over in Japan and you want to buy this home. If you send your spouse and kids over ahead of time to the new home, that still considers that you're occupying within the 60 days, even if you're still stationed out in Japan, let's say. So your VA eligibility never expires and you can reuse it over and over again. If the entire entitlement is not locked up in the borrower's current home, you can use the unused entitlement for a subsequent loan. The certificate of eligibility will state the amount of remaining entitlement if you have any left. So next, let's talk about income. Like I said earlier, the VA does not have a minimum credit score, but banks do. So if you're denied due to your credit score, you can look for a specialty lender. Lenders will check your credit score and look at the debt to income ratio. Again, as we stated earlier, with a VA loan, a lot of times your debt to income ratio is lower. So let's say it might be 41% debt to income as opposed to a conventional loan that might want 53%. All right, so still based on income, let's talk about stable or reliable income. That means active duty income, a full-time job, retirement, child support if it's due to continue for at least 3 years or more beyond the closing date, Social Security and disability. Lenders look at your gross income pre-tax and they gross up the stuff that's not taxed up to 115%. You can use your spouse's income if the spouse is going to be on the loan as well. What they consider questionable income and may not count are if you've got an ETS date of less than 12 months from closing. If you've got an offer letter, that's also questionable. Let's say you get out of the military and you're going to try a contracting job. Conservative lenders may require you to be on the job for 30 days, depending on your lender. Short-term disability is questionable, and self-employment, also questionable income, or bonus or commission income. You need to show stability in that for 2 years or more typically. The things that are not counted as stable income are money that you have coming in from your GI Bill and your BAH for the GI Bill. If you've got unemployment, that is not counted. Or maybe if you've got a part-time job with less than 2 years history. Before you go shopping for your home, make sure you shop around. Different lenders offer different interest rates. Multiple inquiries within a certain time frame are only counted once. Before you go looking at houses, make sure you have a pre-approval letter from a lender. This doesn't commit you to that lender. You can change it later if you need to. But your real estate agent will need a copy of this, and in many cases, you will be required to put an offer in on a house. So the VA doesn't have loan limits. They do, however, have a maximum amount that you can borrow with zero down payment if you've already used your VA loan. The limits are based off of your county, and for right now in 2021, for Georgia and South Carolina, the county limit is $548,250. Now that doesn't mean that you can't borrow over that. It just means that you must pay 25% of the additional amount as a down payment. VA loan amounts apply to veterans who have a diminished VA loan entitlement. So this would happen, let's say if you bought a home for $200,000 and then you live there for a year and now you're PCSing to another place and you want to buy a home there. Now you've already used part of your entitlement, you still have some left, and this is where your county VA loan limit would come into play. If you look in the description down below, I put a link where you can go and check your county loan limits. Okay, funding fee and origination fee. Let's talk about this here. Borrowers pay a funding fee at the time of closing to defray cost of administering the VA home loan program. This is what funds the VA program. The fees differ based on the type of military service, your down payment, first time or repeated use, and your loan purpose. The funding fee may be financed in the loan amount, and it may also be waived in certain instances, such as disabled veterans, Purple Heart recipients, surviving spouses. You can check the VA website to see if this applies to you. The origination fee may be charged by a lender in addition to the VA funding fee, or they may itemize not to exceed 1%. VA requires that the seller pay certain closing costs. So the seller may pay concessions, which are defined as anything of value to the transaction. The VA views concessions of more than 4% as excessive and unacceptable. So some examples of this are paying the VA funding fee, gifts such as a TV or microwave, interest rate buy down, prepayment of buyer's taxes and insurance, credit balances, or judgments on behalf of the buyer. There are some fees that the VA never allows. That would be the termite inspection, attorney fees as a benefit to the lender, a mortgage broker fee, prepayment penalties, HUD and FHA inspection fee to builders, and real estate commissions. So those would have to be paid by the seller. So there are some limitations. The VA requires that the borrower occupy the home as their primary residence. The property can be a single-family home, a condo, a townhome, a manufactured home, or a unit in a multifamily building of 4 or fewer units. They do not allow fixer-uppers. So the VA requires that the home be safe and sound structurally and sanitary with adequate capacity and quality. So that means they don't want cracked sidewalks, peeling paint. It has to have working smoke detectors. The home must have reasonable future utility, durability, and economic life. Issues that are found within the VA inspection must be paid for by the seller, and they require a termite inspection also paid for by the seller. The VA will not finance things not on a permanent foundation, such as a mobile home on wheels or a tiny home. Manufactured homes must be classified and taxed as real property. They must meet VA minimum property requirements. They have to conform to applicable building codes and zoning requirements for real estate, and they have to be properly affixed to a permanent foundation. The VA doesn't allow investment properties unless it's, like we talked about earlier, a duplex where you're living in part of the unit, and it can only go up to 4 units, nothing above that. You can use rental income to offset your mortgage if you have 2 years of property management experience. They do not allow raw land, no second or vacation homes, no businesses, and no farmland. So ideal homes for a VA mortgage would be new construction or homes within 5 to 10 years old. So let's go over VA appraisals a little bit. As with most mortgage applications, there's an appraisal that assesses the value of the property. The seller must pay for the repairs if there are any unsafe issues found. The VA can offer 100% of the value of the home, and that appraisal stays with the veteran, not with the home. So if a veteran comes in, gets an appraisal, 2 months, and they don't get the home, 2 months later another veteran comes in, they have to do another appraisal for that home. VA appraisers assess 2 aspects of the property: the fair market value and the compliance with minimum property values. Although the VA appraisal may identify needed repairs, it's not a substitute for a property inspection and does not guarantee that the house is free of defects. So you should also hire a property inspector. Another thing, if you were to have bankruptcy, you don't have to wait as long with a VA loan to get another loan. So if you were to have Chapter 7 bankruptcy, the waiting period is 2 years. Chapter 13 is 1 year, and a foreclosure is 2 years. Normally, closing costs range from 2 to 3% of your loan. The VA funding fee is the only fee that can be rolled into the mortgage. All others will need to be paid out of pocket at the closing or covered by the seller. The seller, like we said, can cover up to 4% of concessions, and this can be used to offset personal debt to help them qualify for the loan. There's an origination fee, which is typically 1% that some lenders charge, not all of them, and some lenders just charge a flat fee. There are also discount points that can be charged. Each point is typically 1% of the loan, and that you would pay up front. So I know we covered a lot of information here, but if you found this video useful, consider sharing with one of your friends or somebody in your chain of command. If you'd like and hit subscribe, I'd be grateful. And if you've got any questions or comments, please comment in the box below. I'll try to answer them to the best of my ability. Don't forget to download your VA Buyer's Guide in the link below.